Okay, what's up guys? Scott here again with a brand new video. And so today, the August jobs report in the US came out this morning, and it was actually much stronger than expected. And so the focus of this video here is I'm first going to go over the basic facts of that report, but mostly here I'm going to focus on why, in my opinion, a stronger than expected jobs report is actually a very bearish sign for the stock market in the long term. Right, so even though in a more normal economic environment where we don't have crazy inflation going on and things like that, then typically a very strong jobs market and a strong economy would be a bullish thing. But again, with this particular environment with high inflation and rising rates, I think this at the moment is actually a very bearish sign. Now, briefly here before we dive in though, if you guys want to receive up to 13 free stocks where each stock could be worth up to $2,000, then make sure you watch until the end of the video. And then also, if you would like to join a very exclusive online community where you can learn how to trade options and my overall custom approach to the markets, then you can now join my options trading Discord as well. So definitely check out the video description below to learn a lot more about that. And then finally here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on Skillshare as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the video description as well. So be sure to check them out. And when you join Skillshare using those links, you'll get a full 1 month free trial. All right, guys, so now we'll dive in here. And first up, we'll just briefly go over this article, which sums up the basic facts of this jobs report. And so obviously, as you can see here with the headline, the most important thing to understand is that US payrolls grew by 315,000 last month in August. And compared to an expected growth of only 298,000, obviously, jobs in this past month of August grew by more than expected. So that's why basically I'm saying this report was better than most people had probably thought. And then in terms of the overall unemployment rate, 3.7% versus an expected 3.5%. So we missed the mark by a little bit on that metric. And same thing as well for average hourly earnings, 0.3% versus an expected 0.4%, but basically the same there. And this was actually month over month. So then year over year, 5.2% versus an expected 5.3%. So basically the same here as well. But overall here, not just for this report, but many previous reports as well, the overall job growth has continued to exceed expectations. So far at least, the general economy is doing still pretty well. But that being said though, as I mentioned earlier, right now we are not in a normal economic environment, right? Everybody knows, of course, that we are still dealing with some pretty crazy inflationary issues, and also along with that, rising interest rates to try and combat that inflation, right? So for example, as we've seen in the previous two FOMC meetings, which is when the Federal Reserve basically announces what they're going to do with rates, we've seen in back-to-back meetings that the Federal Reserve has risen the federal funds rate by 75 basis points, which has not been done since the 1980s. And then very recently, we saw Jerome Powell, who is the chairman of the Federal Reserve, at the Jackson Hole conference, basically announced to the world in his speech that, yes, indeed, the Federal Reserve is going to continue being very strong against inflation, which of course means we're going to see a lot more rate hikes in the near future. And then, of course, as a result of that speech, if we come over to Thinkorswim real quick, and take a look at the charts here in SPY, basically an ETF that tracks the S&P 500. I'll go ahead and zoom in here a little bit. This was the day right here where Jerome Powell made that speech. So obviously here, just the knowledge that the Federal Reserve is going to continue raising rates in the near future, just that fact alone was enough to send the stock market catapulting to the downside. And then, of course, we've been seeing more continued downside after that point. Right, so generally speaking, when you do have an environment where interest rates are rising quite rapidly, that's a very bearish thing for stocks in general, because rising rates have the effect of contracting economic growth. And there are many reasons as to why that is the case. And one such reason, for example, is the fact that with higher rates, money in general becomes much more expensive to borrow. And most companies nowadays, in order to grow and expand their business, they have to borrow money. So therefore, if loans become more expensive, then companies are either going to think twice about even taking out a loan in the first place, or they're going to simply borrow less and therefore expand and grow their business less. So again, bottom line here, generally speaking, when you do have rising interest rates, that's going to contract economic growth, which of course means less revenue and less profits for companies. And therefore, that should translate into the stock market with cheaper and cheaper stock valuations. And so now tying this back into the stronger than expected jobs report, in my view, this gives the Federal Reserve even more of a motivation or more of an excuse basically to continue really jacking up interest rates further to combat inflation. Right, because one of the main concerns right now about the rising interest rates is the fact that the Federal Reserve might be intentionally or accidentally pushing the US economy into a very severe recession, right? Because again, with enough economic contraction, that's going to lead into a recession. And technically speaking, in the US here, we've already had 2 consecutive quarters of contracting GDP, which means we're basically already in a recession right now. But it could get much worse though, again, if the Fed continues to rise rates even further. So ultimately here, the fact that the jobs report is showing that the US economy is not in very bad shape, at least yet, that's going to, again, in my view, give the Federal Reserve more reasoning, more of a justification, basically, to continue ramping up these interest rates to try and combat inflation. And also here, let's not forget the fact that the Federal Reserve is the major cause of inflation anyway, right? Back during the worst parts of the COVID crisis, the Federal Reserve was printing literally trillions and trillions of dollars to basically purchase bonds and keep rates very low during that time. And so now we are facing the consequences of all that printing, right? So for example, lastly in this video, let's take a look at this page right here. And I have shown this graph in a few previous videos because I do like to bring this up every now and then so you guys continue to be aware of what the Federal Reserve is doing. But basically here in blue, this is the Federal Reserve's balance sheet across the past 10 years or so. And then in red, this is the S&P 500 index. And so like I was saying back during this time, during the COVID crash basically, look what the Federal Reserve was doing, right? Their balance sheet literally went from about, looks like $4 trillion all the way up to, looks like a bit over $7 trillion in the span of just a few weeks here. Right, so again, this means here the Fed printed $3 trillion during this time and then continued to print trillions more after that fact. Right, because bottom line, what this allows the Federal Reserve to do once they print all this money is they can use it to purchase bonds of all kinds, basically, mostly treasuries and things like that. And this has the effect of reducing interest rates. Right, because basically the way that bond pricing works is the more expensive the bond prices become, the lower the interest rates become, and then vice versa. When bond prices go down, interest rates go up. So again here, if the Federal Reserve prints trillions of dollars to rapidly buy a bunch of bonds, and when you buy anything that has the tendency to push the price of that asset up higher and higher, so naturally, of course, this is how the Fed can reduce interest rates. And then also, of course, when they buy all these bonds, all the money they use to buy those bonds go out into the economy to basically the people who sold those bonds to the Federal Reserve in the first place. And that's how we have all this inflationary chaos going on right now. Right, so bottom line, now with trillions of more US dollars floating around, that basically has the effect of devaluing the currencies. So naturally, of course, anything that you want to buy now costs a lot more US dollars to purchase. But of course, all through COVID here, the Federal Reserve felt justified in printing all this money to basically support the economy and support the stock market because obviously, as you can see here, basically the moment the Fed started to print all this money and inject all this liquidity into the economy, the stock market made a very quick bottom here and just exploded higher for the past 2 years almost. So really, in my opinion, if the Fed was not doing all this crazy money printing, then I really do think that because of COVID, the stock market would have done something like this, right? So it probably would have made a small dead cat bounce and then would have rolled over and probably made much lower lows. But now ultimately, fast forwarding to today, the Fed's balance sheet is just under $9 trillion. And the majority of that happening in the past 2 years or so. So yes, even though the Federal Reserve was the major catalyst that brought about this massive and quick recovery out of the COVID pandemic, but now, like I was saying, we are facing the major consequences of all this crazy printing and all this crazy stimulus, which is inflation. And actually, it was announced by the Fed in June, I believe, which is probably somewhere around this zone right here, where the Fed is going to finally begin to unwind all their crazy stimulus. Which means, of course, they're going to begin unloading their massive balance sheet by selling all those bonds. And so then naturally, of course, when they begin to sell all these bonds and therefore push the prices down lower of those bonds, that's going to have the effect of jacking rates higher. So ultimately here, with a stronger than expected jobs market and also this ridiculous balance sheet, in my view, I don't see any reason why the Federal Reserve is not going to go full steam ahead with trying to continue jacking rates up even higher to basically combat the very same inflation problem that they caused to begin with. And so that means for the stock market, just as stocks were exploding when the Federal Reserve was going crazy with all this stimulus, that means, in my opinion here, if they do stay on course with unwinding all that stimulus, what do you think is going to happen with the stock market? Right? So if you ask me, I think we have a whole heck of a lot more downside to come in the pretty near future. And in fact here, this small down move we've seen so far in 2022 is probably just the beginning. And so with that being said here, that's going to do it for this video. But of course, one last thing, as I mentioned earlier, I've got a very cool opportunity for you guys where you can receive up to 13 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 13 free stocks when you open a brokerage account with them using my specific link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the video description below to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the video description. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.